Welcome everyone to this very, very, very special episode of the European VC, because we have moved to the great outdoors on the rooftop terrace of our good friend Mark Penkela. We're here at SuperVenture and we're talking to Niels. And Niels, you're joined next to you by David. And as I said, Mark Penkela here. Tell us a bit about why are you at SuperVenture?
So I'm at SuperVenture because we, as a family office, we are a family office. So first of all, that's I would say that's important. So we are the family office of Niels Fritze, who founded this company 10 years ago, then sold it, or not sold it, merged with another company, and created. We call it the entrepreneurial single family office. And so we want to build up, our VC portfolio, venture capital portfolio, but also while SuperVenture, there's our super return. So we want also to build up our private equity portfolio. And so I want to get to know interesting GPs, interesting VC funds, to see where we should invest, which are interesting and which are not interesting, I would say.
You were both at SuperVenture and Super Return, and I think we just spoke a bit about Kim Kardashian being here.
Yeah.
And we agreed that, well, the big money is at Super Return, but SuperVenture is the hot place, so most likely she'll be at SuperVenture.
I assume so.
That was the conclusion.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting. This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
First of all, let's start out by diving a bit into your story. How did you break into venture?
So my first experience with venture, I would say, started at university. I studied at WHU, which is, I would say, not famous, but quite common for, venture building, founding. But also the first touching points with VCs, when they pitch on, those events, you want to become an analyst at our VC. So that were my first touching points. But then later on, I moved into wealth management and tried to sell VC to people. So did that as well.
How did that work?
I did that 2020 and 2021. So I would say quite perfect. Everything was nice. The money was there. Money was cheap. So
and then you pivoted to a new role because 2020.
Yeah, so I had to pivot. So I pivoted to a new role from, I would say they call it from the sell side to the buy side. So I became the head of family office for the family office. And now I explained I'm now in the really nice seat, because I can decide if you want to invest or not, and I don't have to sell anything. I have to sell sometimes our family office, but I can decide if you want to work with the VC or not.
Let me just ask you, Niels, because we're going to get into a pivotal moment in your career, but I think we'll have some people, and we spoke about that later in this interview. We're going to ask you, what's your advice to your 10-year younger self? And then you said, I thought, what would I say to a 16-year-old Niels?
Yeah.
And I have to ask you, how does one end up being the head of a family office as a 26-year-old?
I would say I started young at university, and then I didn't do a master degree. That was the first difference. So I started right after bachelor, went to London, did some investment banking, decided, okay, investment banking is not 100% what I want to do in the near future or the next 10 years. So I switched to wealth management. What do you do in wealth management? You speak to very interesting people. Sometimes you speak to very, prosper, they build their own company, and they're, you learn a lot from them, and you start to, develop your own network. And then when you network, you have the opportunity, and then sometimes the opportunity comes and you don't have, I would say, you have a clear vision, and you sometimes look also left and right, and then said, do you really want to get into the family office space? And then I said, yes, of course, why not? And then me and Jens really got along very well. Yeah. And he said, smartness has nothing to do with age. Yeah. It's about, how you commit yourself and how you, turn, or how often do you say you have to think outside the box. I would think, that's the most important thing he says, because, that makes really the difference to all the others. And so then he said, on my side, I'm fine. He said, okay, let's do it. And so then he said, here's the job, let's start.
That is a great story. Now give us your pivotal moment in your career. What has shaped you as an investor?
It was, I'm now in the industry now for almost 5 years. And I think, I experienced something, people didn't experience the last 20, 30 years, Corona. It was really interesting. I was sitting in London, right at that time in the equity research department. And you looked at, the senior analysts left or right who are in the market for like 20, 30 years. And they had no clue what's going on. They had no clue. They were like, I don't know what to tell the investors. We don't know. It's like markets are crashing, stocks are crashing, investors are ringing every 5 minutes. What's with the portfolio? What's with the stock? Do I have to sell it? And the answer was, we don't know. And, yeah. It's but it was like, we don't know. And that was like really, really interesting to see how markets can really crash. It's crazy. So they call it the black swan year, but it happens. And so it was quite interesting in the start of my career. I was sitting in my apartment in London. I was not allowed to leave my apartment due to the restriction. Markets were crashing. Nobody had a clue. It's like, okay, nice start into your business career. We don't know if we have to stay the next 20 years at home. We don't know if the bank will survive, because there was a big topic. Does a bank survive if there's no investment banking revenues, if everything is crashing? So I was like, was quite, and then what pivoted was like, I became a little bit more risk averse, really. I was like, don't be so much risk loving. You have to have a great mixture, for example, in a family office portfolio, to sometimes to react to certain market condition. Try to, we call it like statistic, try to have the, the correlation effect as small as possible. How you can do that? You have to be, creative. Which asset classes do you want to include in your portfolio? And then venture capital is like one piece of the portfolio. Then private equity is another piece of portfolio. Real estate.
Take a star.
Now I'd love to hear you take a stance on the statement that most families do pre-seed and seed funds for the co-invest opportunity.
100%. Why? Just a short question to that. Family offices or families or rich families, I would say, well, wealthy, rich is not wealthy families.
Yeah, we can't say rich anymore. That's only in the US they can say rich.
Yeah, wealthy families, they don't like to be known. It's really crazy. Like, for example, we work sometimes with really wealthy family offices, and they say, your family office is like the first barrier. You do the DD, and if you say it's a great investment, then you can introduce them to them, because they don't want to do good at introduce to every startup, and they don't want to have a website which states, okay, this is the family of there, and they invest in the VC space. So that's the reason why they enjoy VC investments or fund investments, because it's more anonymous.
Goal 20 years back, we would have definitely a different view from what we have today on how much alternative assets should be in your portfolio from wealth management perspective. And last 2 years definitely saw VC also growing some. And I'm curious to know, well, how do you think about that now? Because
about alternative investments overall, or about VC?
The entire alternative asset class, and then VC as a subsegment.
It's nice to see, we always say, the States or the US is always first. When they do something, Europe follows 5, 10, 20 years later on. And what happened in the US, alternative investment, illiquid investments became so popular. If you look at the biggest endowments in the US, it's huge part. Of course, 2020 and 2023, maybe they have to reduce a little bit, because, stocks were crashing, bonds were crashing, and they have like a fixed strategic asset allocation. So they were forced to sell the alternative investments. They didn't want to sell it. They were forced to sell it. But I would say overall, for every family office, for every investor, it doesn't have to be a family office, you have to be really keen in building up a really diversified portfolio, which includes alternative investments, which includes venture capital. It doesn't have to be sometimes a fund. Sometimes, you can also you go the other way, you go like direct into the company and do something there, but you have to diversify yourself to be ready for the next crash, for the next black swan year.
The question that is probably for you ever since you transitioned been, a lot of learnings, right? Because the first time now in a family office, really, have to get into the mindset of how does a family think. And that is what I want to dive into, because that is, I think, probably the most often heard question from a VC is, well, so how do I raise, and then there's all kinds of questions about how you raise from LPs. And given that we speak to a lot of emerging VCs, it's primarily families. So I'm looking very much forward to dive into the topic of how does your family think, and how do you see families in general in literature? You strike me as someone who's probably read a bit about it as well. So
you phrase it on the VC side also, but we get a lot of questions from startups, which also start to ask, how do I raise when I go to a family office? Because it is different. So when they say, Niels, okay, here's my pitch deck. Is there anything you would change so we get more attractive for family office? Why? Because I would just say pre-match, a big part of their cap table was family offices, or there was family office involved. And so other startups want to have family office as well as now as LPs or investors. But for VCs, I would say what makes us family office, or why our family office sometimes different, is that we look at VCs a little bit more like different. For us, it's really important that VC works with our capital very efficiently, and maybe also invest into companies which strive more for profitability than revenue growth. Why? Because we don't want to dilute our shares in the next funding round. We want to have always a big share in our investment. And we say it's for us better when the company grows a little bit, slower but healthier. And so for us, it's...
And you're saying that because you prefer to co-invest with the VC either at first ticket or later on, and your temperament as a family would rather invest in something that doesn't dilute us as hell and maybe doesn't grow as big, but then at least, we know what we're looking at.
Yeah, I would say that's a big part. Also when we invest in VCs, I don't, I can drop some names, but, for us, like a very nice VC investment was a VC which convinced us that they would invest rather in more mature companies which have a track record of profitability than a VC which tells us, we are going to find the next 1000x and that's how we're going to do the return.
Yeah, and that is incredibly interesting, because I'm usually definitely banging the drum of the unicorn hunters, and I'd love to bring in both Mark's perspectives and David's here, because I tend to say, well, it's not that there's not a place for the other type of investors and a place for the other type of startups. It's just that is what I'm looking for when I do venture.
No, it's very interesting. Like when we started fundraising, we talked about okay, what kind of type of investors do we have as a VC fund? So we looked obviously at high net individuals, family offices, multifamily offices, fund of funds, institutionals, and all of them have a different rationale how they approach LP investing. And interestingly, we had all of them today here. We had a fund of fund, we have multifamily offices, we have by design. Yes, come on, it was all tailored, and the motivation differs a lot. So I wouldn't say that our pitch differs when we speak to them, but we try to detect what are they actually looking for. Fund of fund, it's a pure financial play. They put money into a fund, they pick 15, 20 funds, and they want to have a blended return of X, and this is their business model. Institutional, they have a little more, okay, look, we have to deploy a lot of money, so yes, we do need financial return. It doesn't have to be the stellar 30% IRR. It has to be way above private market equivalent, and we're happy with that. Looking at high nets, you have to convince them with your brand, you as persons, they have to like you, they have to feel engaged. Sometimes they look for co-investment opportunities. Family offices are a very different animal, because the reason why they invest can differ so much. It could be we want to learn. That's the first touch point to VC. We go into a fund of funds, then established VCs, and then we go all the way down to emergent managers. Others look into, I need funds which invest in my ecosystem, things I would do by nature as a direct investment. And there's others which are either driven by impact, or I want to do something good, I want to pay back, or a combination out of, hey, it has to be something which I understand and like, plus I need the stellar return. Yours is very atypical, not worse, not better, no judgment. It's just atypical, like how we approach this, but actually very interesting. So I think it's very important for you as a family office, but as well for all of us, to understand the actual rationale why they would love to invest into a fund before they pitch to them. Otherwise, it's just going to be a waste of time if you speak to them to 1 hour to detect at the end of the call, no, there's actually no fit, because what we seek for is something different.
To build on that and to answer your question, Bill, I think it also we come from also different perspectives, right? So you said like I'm drumming the beat of unicorn, because I'm less so, to be honest, and you know that, right? But I think what we have in common, and Mark, you as well, right? We love the early stages, right? And we come from that because we are only doing venture. It's a very different context, a very different perspective, a very different risk profile, very different strategic objectives. And so, I wouldn't drum the beat of the unicorn hunter. I love dragon hunters actually above all, right? I love fund returners. And I think it a lot boils down to that, right? Because we're hunting for different things at the end of the day. We're trying to achieve very different things.
It's interesting that it's for you it's unicorn, for you it's something intermediate. For us it's like we look at it from a portfolio perspective. So we look for neither unicorns nor dragons. For us it's called Cerberus. We look for the companies which can sustain by having a bread and butter business in SME, but still go up the ladder into enterprise, where they have the cherry on top in terms of very long contracts with high average contract values. So companies which are very close to cash. And for us, this is the way to go, because you can nurture them and grow them slow but steady, and can build very great cash flow positive businesses which create value throughout that approach, and not by hyper growth. I create 2 billion in valuation with 1 billion in revenue, burn through 5 billion to generate the 2 or 1 billion revenue, which is like, okay, that doesn't make sense.
Which is also right now crazily expensive, I would say.
Yes, exactly. And it takes a lot of time, and you're exposing yourself even to more risk, because you have to go to multiple rounds, multiple dilutions, and you literally die the moment where VCs say, okay, we can fund this. And there's this very weird magical ceiling in Germany where it becomes very hard to raise funds, because you have to tap different top pockets from the US, from institutional investors, from pension funds, endowments. And that's a different ballpark. You don't have too many entrepreneurs who have the skill set to do that.
Yeah, and it's nice you said that, every fund or some of our VC funds, they have really there was a specific reason why we invested into it. Either impact or a special strategy, or, for example, jetzt our AUXO with the female founders fund in terms of that, it had all a specific strategy which the fund follows. And they convinced us, and we thought, that's a great idea. I think it will be way harder for funds for, I would say, better funds who just, they just experienced, they did their return on the beta factor, and they didn't really generate alpha. So, they were surfing the wave of the beta to differentiate themselves from the other VC funds. And so I'm really interested how the next couple of months will really turn out for VC funds in terms of, how maybe they shift in their strategy, how they want to differentiate themselves from all the other funds, maybe also consolidate. That would be also maybe an interesting thing to see, that, some VCs try to reduce cost, and maybe, they see some synergies within their portfolio when they consolidate. So I'm really looking forward.
I want to try to tease something out of you, because you just said something about costs before you said about deploying capital efficiently. Could you expand a bit? What do you mean by that? Because a skeptic listener might feel, that's someone that's adverse to fees. And that brings us to the old topic of, and especially us doing a fund of funds play, it's even worse, right? So I think it would be great to hear your perspective there.
That's different as well when you go for family offices and for maybe angel investors, or for retail investors, I would call them. We also have a really, I would say, a hawk eye on the fee structure. So for us, a red flag normally is fees on the committed capital or not on the invested capital. It's just because we want to operate our family office. Or family offices, they see a family office like a business.
Throughout the process, throughout the lifetime of the fund, or
in the divestment period?
Yeah,
in the divestment
it depends, like in the divestment period. But a fund or a family office operates like a company, like a real business. And we want to deploy our capital, which is scarce, because what I say to investors or to startups, which makes the biggest difference between a family office and a fund, we have only one guy who has the capital, the principal, the founder, who did the exit, the family. We cannot raise somewhere else money and deploy it, so we have only a very limited amount of capital. So for our objective, it's extremely important to efficiently deploy the capital. And then fees is also a part of it. We have to look into it.
So what's an appropriate fee structure, looking at you have 100% of the fund, what's the maximum which can actually go into fees, like organizational expenses, management fees and setup cost? Where's the threshold? I have a number in mind which I like. I looked at a lot of funds, I worked with a lot of funds, and we in particular took lots of time to think about it. How do we actually draw fees? When do we draw fees? And how much do we draw to maximize the actual amount which we deploy into assets? Because when you kind of have a smaller spread between the fund size and the deployable capital, you increase obviously the potential return, because MOIC and TVPI get closer together, so it's easier to create stellar fund returns. So do you have a number in top of your mind?
No. I have to pass on that. We don't have a number of that. I would say it's different. We are open for every fund. So it's know that, of course, what we have to do, we have to analyze. It's like every investor, like also a VC investor.
It has to make sense.
It has to make sense, and that's different. And if the fund, and we like the GP, the strategy makes 100% sense, and everything is perfectly fine, and they do a fee structure on committed capital, and the fund is super expensive, then we will also say, let's do it because we believe in the idea or in the strategy. But it's just one part of analyzing, or we do a grading of if you want to invest or not.
The devil's advocate here would be, well, fees is one part of the equation because it's all about that MOIC to TVPI difference. And there are ways a fund can offset the fee effect, right? There are ways, and there's also ways for fund of funds, right? So at the end of the day, fees is one small part of that big equation of deploying capital efficiently, right?
I would say my founder would say, when a fund does 5, 6, 10x, no one gives a flying about the fees, because they were rich, they made huge ton of money in a really short time. We always think about 8 to 10 years. It's really short when you take it into the investment horizon perspective. Of course, now we're getting into more choppy water, and I would say it's harder, or it's not possible, but really harder to achieve the same returns which were achieved in the last couple of years. And that's more about, macroeconomic reason, political reason. There's so many reasons why it's going to be harder.
I think it's just going to be harder on short term on paper, but on the long term, it's going to be the best vintage in the next decade.
True that. And then, this really, really famous saying, under pressure, you create diamonds. And maybe if you have those maybe solid rocks or coals in your portfolio and they become now diamonds, then maybe a 10x is nothing, because it will be 1,000x. But we as a family office would say we look very differently. We look on return on capital efficiently, how efficiently we can deploy capital, and opportunity costs. And nobody talks about the opportunity costs. We can invest in VCs, or we can go on the bond market and.
We had this discussion earlier, that's why everyone is laughing. It's where's the magical threshold of what kind of money does a VC has to return in terms of IRR to justify the illiquidness plus the risk? And it's very hard to answer.
But the funny thing is, a private equity who is in business for 40 years could not answer the question. I would say it really depends on, and I would say VC and PE are two asset classes which are necessary for every portfolio. That's 100% sure, and there's statistically data which clearly supports that. And luckily in every, I would say, strategic asset allocation which are done by banks, you see the PE and the VC, the liquid share is getting bigger and bigger and bigger from year to year. However, you have to be careful that, you know, the liquidity of the investment makes it for some investors more difficult to handle, I would say.
How exposed are you guys in venture capital, or let's call it alternative assets, to make it more gravel? It's like, especially as a family office, you said, okay, you're an asset allocator, you want to be diversified, you want to, of course, mitigate risk. But by nature, usually the highest yielding asset class, venture capital, has the lowest allocation, looking at like all the stuff you've been doing from real estate to PE to bonds and name them all. So is there a magical number you're looking for? Is it
We have one. So we have our illiquid investments, which we don't count real estate into it, just private equity, private debt, and venture capital is 10%. Also 10% of our AUMs we want to maybe deploy in those regions. However, what makes a little bit why we are different, because we have our own scale apart, like we have our own founding company or incubator, we call it, which are also illiquid. So we say we found our own companies. We don't want to get into so much into the VC space when we're also doing direct investments. And
okay, so when you say 10% to alternatives, you don't count your direct investments in that. That's in a bit of different bucket.
It's a separate bucket.
It's a separate bucket. The 10% is really like, I would say, illiquid institutional products.
All right. Well, looking at all your allocations and all the buckets, what's the outperformer as of now?
It's sad to say from my side, because I love, private equity and capital markets, but it's really the real estate. You have steady cash flows, and it's not predictable, but it's predictable in terms of, cash flow. Also, can then say, the interest rates are so high and stuff like this, but it's really still one of the most profitable or return driver of our portfolio, because the leverage impact has such a big impact on the return. But
we spoke about it just earlier today.
No, totally, it makes all the sense. I mean, venture capital by nature is just illiquid and it's risky, but it usually yields, if you're in top quartile like performance terms, just the highest returns. But you have to be a good picker.
People say, you're not really talking like too positive about VC. For example, I say venture capital on a fund basis is perfectly for every investor who wants to get in like a foot into the VC world. For example, I would say it's way more risky for angel investors, in my opinion, to invest into companies they have no clue about. It's for me like going to the casino.
This is exactly.
That's exactly our thesis.
I don't know how much you know about us, but at EUVC, what we do is we do syndicates that primarily angels that join us in investing into funds, and we're exactly touting that horn all the time, because you're seeing so many people. I think the most often heard story in angel investing is, well, I did 5 investments and now I'm kind of out of cash, so I'm out for 2 years or so, and then hopefully one of them will. And like, no way 5 are gonna return anything, right?
So, for example, our plan is to do like 15 at least a year. Yeah. This year we will not reach 15, but that's more because of, I would say, human capital shortages on our side right now.
Yeah, you're setting things up.
Let me ask you a parallel topic, because we're talking from a very quantitative perspective right now, but you also said that you've committed to funds because of the impact angle.
Yeah.
And I also want to ask you, I think I know the answer, but I want to ask you, real estate is amazing, right? You just said that, but there is something that is non-quantitative with the idea of funding the future, which VC allows you to, right? And how much does that matter to you guys?
It's a really interesting question, but the funny thing is, I would say there is a solution in quantitative real estate in terms of impact, and it's called the energetic restoration of buildings. Yeah. And that's what we focus on in our real estate portfolio. Yeah. So we're doing impact as well on our real estate side. Yeah. But I would say in terms of investments, we also look at VCs or also direct investments where there is a positive impact which the fund can make. For example, we invested into Tain, which is a positive impact fund. My founder says, we have now the capital, and I want to give something back to the community in terms of mentoring, capital, and anything else I can provide. Because, I took something the last 10 years, I made money. Of course, he had to pay taxes, so of course he gave something back. But he wants to also, said, my time is not up to give back. And so that's really important for him, that we have a strategic angle in terms of impact investment on the real estate side, in terms of energetic renovation, and then also on investment sides.
How active or passive are you, or do you want to be, as you mentioned earlier, that like the thing which is scarce for you is the human resources and like the ability just to be very active. Like looking at your fund investments, how active are you?
So I would start, there are some parts we totally do passive, and it's, for example, a big part of our portfolio of our assets, which are just plain in ETFs, I would say. That's what I think should every family office do, because it's so hard to generate alpha in the capital markets world. On the other side, real estate, venture capital, and direct, we are extremely active. As an LP in terms of VC, I would say we're not as active because we don't sign the sizes which really matter, or whether VCs would say, okay, it's one of our biggest investors, so we have to care more about them. But I would say on the direct investment cases, we are extremely active. We would like to work with them together. We want to see if there are any synergy effects we can develop as an investor. And on the fund size, I would say that's the reason why we're hiring right now an investment manager, because we want to analyze, or we want to analyze more VC cases, and we want to analyze more VC funds and say, really, okay, this is a great VC and this is not a great VC, to then go to our angel investor network and say, we have analyzed these funds, we have invested there as well. Our investment manager tells us it's a really nice opportunity, you should invest as well.
What's your magical power you bring to the table for a fund and for direct investment? So usually, like an angel's family office does as well, like you bring something which is like a domain expertise, knowledge, network, whatever. What is yours?
Like my or my fund?
Like the family office, like in general. I mean,
like I would say I don't have any expertise, so I would be no value driver. I would say one.
That's VC humbleness.
I was about to say this is going to be titled the humble family office guy.
I would say first of all we bring capital, which is, I would say, one of the most important things, because without capital you cannot invest. And what we do when we are really committed into a VC case or into any other case, we will target our angel investor network or other family office we know and say, this is a great opportunity, you should invest as well. So that's one benefit VC gets when they work with us. And the funny thing is, the family office space, it's a community. So when we invest in them, it's for them like made in Germany, I would say. When one family invests in this thing, okay, it can't be bad because, they have analyzed it, they did their DD on the VC, they did all the other stuff, we should invest as well. And then on the other side, which we can also bring, for example, if it's like e-commerce, then we say, my founder, he had like a really, one of the biggest, not Amazon aggregator, but aggregator, like Amazon shop builder in Europe. He knows how to do online e-commerce, for example. He would say, if you have anything to do with like direct to consumer or like any other stuff, you can always ask our founder.
Anyone from the outside would quickly look and then probably also expect that if they're investing in that space, as a VC, then you're going to be more interested. Is that true or false? Because some would say, well, we like to complement our directs with also doing, VC investments in the same space? Or do you go the opposite route and say, we do that in direct, so don't come to me with more of that?
It depends. I know this word, it's really
okay,
hated.
So you can see the bad ones quicker, so for that reason they're quickly out?
No. For example, it's just, for example, my founder says, my principal, he would right now invest so much into the e-commerce space. It's just because, he said Corona was the best which could happen to the e-commerce, and it cannot really get better. And so you say, there might be, like a downturn right now, maybe also a valuation downturn. So like, for example, like an VC which would focus just on e-commerce would be not into our best focus. But it doesn't mean that when we also do the direct investments in that area, that we don't want to invest in a VC, which also does direct investment in that area. For example, sometimes we say we have to invest into VCs, or we have to take VCs into our book, because a VC sometimes gets the better deals. And that's totally true, and we know it. And that's the reason why you have to invest into VCs as a family office as well sometimes, to get into the top-notch deals.
Yeah, but that would also be my main argument, and also why I would always say, well, even though you are very active in e-commerce as an example, then you'd still do the best VCs there, and you probably know them already because you're active there. And as you said, the main thing you guys bring is the capital in the end.
Yeah.
And most VCs will say, well, give me capital, I'll be your friend.
No, totally. I mean, it's like in an up market, capital was a commodity, so it was just vastly accessible. So you had to bring something else because good funds have been oversubscribed. In a down market, it reverses. So it's like, okay, bring me the capital, that's absolutely enough, I'll take it. But on the other hand, if somebody as well brings something which is very valuable, and in this case, the second layer for everyone who's raising right now is obviously network and access to others and signaling like, look, this one is participating in our fund. Like name dropping is a thing, institutional, family offices. Like if you can just bring this up, say, hey, they've invested, it gives you this certain halo where people always said, oh, they invested. Okay, that must be good. So obviously just the brand can be a very, very powerful asset aside of money. And this is nothing you literally have to work on. You just have it because you have done this for the past 20 years and you build a brand.
You mentioned a really important topic, brand building in the family office space. We are trying to do our best because through brand building you get the nice deals, and that's the reason why we love to speak to a lot of people who want to expand our network. And we do that also through VCs, and we say, okay, maybe we don't invest in your fund, but if you have a nice investment which fits to us, we are very happy to do like a co-investment with you, to take also a share and support you there as well, or you can think about us like an angel investor you're going to take within the cap table. Yeah.
But the problem here is it's funny because like you run a VC, you have a co-investment opportunity, so the most obvious thing is you ask your LPs first. If everybody says, hey, no, thank you, then they're going to come to you because you didn't invest in the fund. It's like, I have this special opportunity only for you, and it's amazing, you should do this. So the likelihood that you will not see top-notch is very high. You're going to see the end of top-notch, and this is not what you want to do. So that's why I think like from a family office, multi-family office perspective, having like a blended approach to fund investing, having 10, 15 funds with 30 companies each, having a portfolio which is indexed 300 to 450 companies, then do specific picks on the ones which are interested, which you like, because you can A, build conviction, B, you have the entry point, and C, you are the first person to be asked, not the third or not the fourth. And that's a very hard aspect. Even though if you have a brand, even though if you have the relationship, you still be not the first one to be asked to invest.
It's funny that you bring that up. I just want to add to it because one of the things I do think about with the funds that we have invested is, and it's not putting the onus or them or critique to any of the funds that we were working with. It's just like I do think about, are we getting offered the good co-invest, right? Or not that we're doing it now. We're actually never done a deal like that, but we'd be interested in looking at them, right? And so I think about, we're such a small LP. We are an LP. We're such a small LP. Am I getting those? And to be very honest, I don't think we would get the hot ones.
Go first, but I have a good answer how I see the world.
It's a really interesting topic. I would say there's a switch right now from seller to buyer. And this is also in the family office space. I mark 100% 2021. The family office, they only got the shit deals, like the real bad ones. Like if you're a startup and you can't raise anything, you go to a family office and they say, they deploy their dumb capital. And what happened, for example, and then, at a certain growth or a certain size, big startups go to banks and they say, okay, VCs don't want to give us any money more. What can we do? And then the banks come and say, we have family offices. Maybe you can pitch them your idea and they will invest. In 2021, 2022, I would say, or 2020, family offices were in the food chain the last person to eat. Except you were like a huge family office and everybody knew you and stuff like this. But now there's like a shift. We have some founders who come to us now and say, we want to invest, or we want to have a family office as an LP rather than a VC. Why? The pressure a family office gives in terms of growth is way less, and the strategic impact they want to, have is way less. Like a family office, sometimes it's more like, you convinced us about your idea, you have a great team, do it now.
This is in a way a stupid thing to dive into because we don't have too many founders listening to our podcast, right? But I've always thought that there's so many people raising VC money, founders raising VC money that should not be raising VC money, right? And because they're not on that path, it's not, and then there's VCs that are not really VCs and they're just investing in startup stuff. But in my perspective, they're not looking for the big enough valuation increases or growth journeys, however you want to frame that, right? To be really put in the real VC bucket. And then now everyone has had their hands burned on people not knowing what they're doing. And I cannot help but think that what you just described is, well, those founders should not ever have raised VC. And neither should they today, right? It's only sobering, and I'm happy to hear that they are seeing that there's an alternative to VC and that we needed a market to blow up for them to realize that maybe my business isn't fit for VC.
But especially what you picture, not every case which is built is made for VC. And sometimes it needs patient capital, like people who are evergreen, who don't have like, oh, look, by the way, I have to divest in 6 years. You're going to be ready to sell your company, right?
And I'm like, you've never met a fucking VC? If you think that that's patient capital.
Yeah, exactly.
Did that guy look patient?
Picking up on what you said about like, do I see great deals? I think it's very interesting. It's completely unattached whether you're going to put a 200K check or a 4 million check into a fund. Unless you have a side letter, then you're like literally like, okay, I'm going to see these deals and I have the first dip and I can execute upon that. It's building the personal relationship between the LP and the GP. Because at the end of the day, it's on his discretion to say, I'm going to give this to you and to you. And as an LP, who am I going to give it to you? All of them who want to give me money, give me one thing, money. The second question is, what are they adding to this specific company? If it's access, knowledge, whatsoever, which is highly relevant for them to become successful, I'm going to pass it to exactly that specific LP. So for us, it's always like, how can we build a good relationship with the LPs of interest? And for them, it should be the same thing. How can they build a specific relationship to the GP? If you never call them in 4 years throughout the investment period, and all of a sudden the investment period after 5 years ends and there's an opportunity and you call them 8 times a week, you're like, well, we have not built a relationship. It's the first time you literally call me. But if you are interested, if you actively help, obviously the likelihood increases that you're having the first dip on a great deal, whether you put 200K or like 2 million. So
for me, like it's our view is like, as an LP, you should try everything you can do to help your GP. Why? Yeah, so it's like, it's a no-brainer. I would say.
Not every LP acts like that.
Yeah, but I don't understand why.
Resources, knowledge.
Okay, could be, but if you have the knowledge and if you have the resources, it's like, okay, then okay, maybe if if I put everything in, the others will get the return as well and didn't do nothing. But still, like I would say,
but you get the return as well.
Yeah.
So it should be an intrinsic motivation to say, I'm going to help. It's like with a startup. I give you money and I give you everything I know I can and my network because I want you to succeed. And I don't care if all the others succeed. It's fantastic, so everybody gets rich. But for me, obviously, the intrinsic motivation that they become successful is very high because I have skin in the game. It's as simple as that.
Love is in the air, everywhere I look around.
And now I want to hear you give your shout out. And for our audience, I just want to say it's super funny because you're mentioning someone here who you said something earlier where I thought, he must know that guy.
Yeah.
So give us your shout out.
It's Jan Voss. He works for BN Capital, which is always one of the more known family offices in Berlin. And through him, I got the job. He was the guy I always talked to, and then he referred me to Jens, to my founder. And so he works also as my sparring partner in some ideas and in some areas. And so great investor, great family officer, and he has an extremely, if you read his LinkedIn post, he knows his stuff. Absolutely. And you can learn a lot from him.
So guys, I want to take us into the 3 biggest learnings from your LP investing. We will not be diving deep, but I want to just hear them from you.
I would say time is important. Really choose who you want to talk to. Don't talk to every VC because you have limited time. When they ask you for a meeting, look at their website, look at how they invested, and if it's really interesting you, then you meet with them. Because it makes no sense with meeting with 1,000 LPs, VCs. That's I would say one of the most important learnings. And then, which is quite important, ask the VC if they really know the portfolio companies. It's crazy. Like, do you know the management team? How you interact with the management team? Because you really sometimes hear it when they talk about every detail about the portfolio company. Then okay, they really have their skin in the game. It's not just buying and holding. It's more, creating the alpha, get into the business model and create value.
I think that's a really good one. It's not. It's actually funny because I'm messing up Andreas' hosting here, but it's sometimes you talk with these GPs and they just get so fucking excited about the companies they're investing in, to a level where sometimes you even find yourself zoning off a tiny bit, right? But it's actually a good sign. But it's actually a good sign. It's actually a good sign because, as you say, they are really in it, right? They're really, really, really kind of working with these companies. I love that.
Yeah, I would say it's hugely important.
Now let's go to the quickfire round.
And now, the quickfire round.
The very first question in the quickfire round is, what advice would you give to your own 10-year younger self? And that's to 16-year-old Niels.
That's 16 years old. Right now, I would say, enjoy your life to the fullest. I would say that's always the first advice I give. Try to look left and right all the time. Don't have like only one vision, And the last one is become or do something in handcrafts, man. It's like a market which is so unsaturated and it can be so. It's like the best market, I would say, to work.
So investing in VC is not a handcraft?
Could be, yeah. But physical handcraft would then refer.
Did a lot of mistakes.
I like that one. And now I'd ask you, what are your top tips for emerging VCs racing across Europe?
First learning by far is know how to pitch your VC and get expert help, I would say. Get the coaching where, get coaching, active coaching in terms of how to pitch your VC and how to pitch your strategy. What, I experience a lot. After 30 seconds, I'm not really interested, but sometimes it's not about the VC, but it's just about, how they talk to you. There's no fire and there's they explain something which it's not really relevant for you. And so it's get professional help in terms of pitching, which I also did or got when I was at my bank. Then he said, you have to get coaching in terms of how to pitch, because as I said, 30 seconds in the beginning are the most important 30 seconds you have, and you have to convince the other party in the first 30 seconds, I would say.
You have another one that I know that we spoke about just before, which is know your team very well. Have a great story for each team member. I love that one.
That's for emerging, I would say, funds extremely important, because I would say emerging funds would have not the team size as well-established funds. And so I always ask them, okay, who's in your team and who's the team member? And when they don't really know it, it's like a really bad answer, because it shows there's no really team spirit and there is no, they don't know what's going on in the company. And why do I want to have team spirit? Because I would say for emerging VC, maybe you have to work way harder than an established VC, and you have to have a really nice and great team to achieve that, to become from emergent to maybe established.
Absolutely. And now the final one, what is the most counterintuitive thing you've learned since you've started investing in venture?
Sometimes it's really, well, it pays out way more when you reinvent an old idea or an idea which was already in place than invent something which has no use. It's sometimes really, when I look at startups and ventures, say, you know, I don't need it, nobody needs it. Maybe you should focus or pivot your strategy to something, you know, in the same space, but the market is already there. So that's my statement, I would say.
Thank you so much for joining us today. It has been amazing to have you with us, Niels.
Thank you for the invitation.
Thanks. You're welcome.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting.